Two things happened in the same week this June. On June 11, Blackstone's head of private equity, Martin Brand, stood on stage at the Super Return Conference in Berlin and said, "The year of the IPO is definitely on. Larger, higher quality companies are driving the pipeline. The exit engine is running." 6 days later, on June 17, China's securities regulator announced at the Lujiazui Forum that the STAR market's fifth listing standard, the one that allows zero revenue, zero profit companies to go public, is expanding from biotech to artificial intelligence. Same day, a separate proposal opened the gate to quantum computing, biomanufacturing, and embodied intelligence. Two signals, same direction. The exit gate is opening, globally and locally. I chose this topic because the coverage is all about opportunity. More companies can list, more capital can flow, all true. But I've spent 10 years watching what happens when exit pathways open in Chinese markets. The pattern is consistent, and it is not what the headlines suggest. This episode is about that pattern. Timing mismatch leads to capital mismatch, which leads to value destruction. The gate opens, but the cost of arriving at the wrong time does not disappear just because the gate is open. Start with the numbers that make everyone optimistic. In the first half of 2026, A-share IPOs delivered an average first-day return of 233%, the highest in 5 years. 68 companies listed, raising roughly 62 billion RMB. Average proceeds per IPO reached 1.3 billion RMB, up 49% year-over-year. Technology and manufacturing dominated the pipeline. The STAR market's growth layer tells a similar story. 34 companies currently in the growth layer. In 2025, combined revenue up 18%, total losses narrowing by 18%. First quarter 2026, revenue up 35%, net losses cut by 52%. 6 companies, including Cambricon and Beijing, have crossed the profitability threshold. Average stock gain since the growth layer launched, 34%. Hong Kong is booming too. First half IPO proceeds hit a 5-year high. 19 A+H dual listings in the first 5 months, already exceeding all of last year. Since the 18A Biotech chapter launched in 2018, 90 companies have listed, raising 142.9 billion HKD, 17 listed in 2025 alone, 6 more in the first 5 months of 2026. Everything points up, more listings, higher returns, broader access. Here is what the celebration leaves out. The 18A chapter is the proof case. Since 2018, 90 companies have listed under Hong Kong's Chapter 18A for pre-revenue biotech. Of the first 64, those with enough trading history to judge 60 broke below their IPO price, that is 94%. The average loss from issue price, 71%. 70% of the original 18A cohort still trade below their IPO price today, even as new 18A listings in 2025 and 2026 double on their first day of trading. Two groups of companies, same listing venue, same rulebook, opposite outcomes. The new entrants get repriced upward. The old guard stays underwater. Why? Asset quality doesn't explain it. Many of the old 18A companies had legitimate pipelines. Timing does. When they arrived at the gate relative to when the gate opened, that is what separated the outcomes. The first wave, 2018 to 2021, listed into a narrow window. Valuations were pulled to the ceiling by pent-up demand. When the commercialization timelines stretched beyond what the market was pricing, the gap between expectation and reality widened into a canyon. By 2022, the window had frozen. 24 A-share biotech IPO applications were withdrawn or suspended in 2024 alone. Only 5 completed the process, the lowest number since 2008. Companies that missed the A-share window were forced to Hong Kong. Hong Kong's liquidity pool is shallower, same assets, thinner market, lower price. That liquidity discount is not a one-time haircut, it compounds. Lower valuation means less capital raised. Less capital means less runway for R&D. Less runway means slower execution. Slower execution means the gap to expectation keeps widening. Here is where most analysis gets it wrong. The conclusion people draw from the 18A story is the rules were too strict. If only the gate had opened earlier or wider, the outcomes would have been different. I disagree. The problem was never the gate, the problem is timing. Cambricon listed in 2020. Revenue that year, under 300 million RMB. Market cap at IPO, roughly 70 billion. For years it traded below issue price. Then in 2025, revenue surged 453%. It went from losses to single quarter profit of over 1 billion RMB. The valuation gap closed. The stock is now at an all-time high. Cambricon is the 1 in 1,000 case. For the 60 out of 64 18A companies that broke below IPO price, growth was not fast enough to close the gap. Time made the wound deeper, not shallower. The gate opened, but the gate is not a solution, it is a passage. Whether you make it through intact depends on what you built before you got there. The 18A story is not a one-off, it is a structural pattern. 4 steps. Step 1. Rule lag. Industry develops faster than the exit pathway built for it. Biotech boomed from 2015 to 2019. The 18A chapter launched in 2018, but only for pre-revenue biotech. The STAR market's 5th standard opened in 2019, initially only for pharmaceuticals. By the time the rules caught up to the industry, the best window for many companies had already passed. Step 2. Capital mismatch. Companies that could not access A-share listings went to Hong Kong. Hong Kong's liquidity discount compressed valuations, less capital raised, less runway, slower execution. The cycle feeds on itself. Step 3. Concentrated release. When the gate finally opens, the backlog rushes in. Supply shock compresses valuations for everyone. In 2025, 17 companies listed under 18A in a single year. The market could not absorb that volume at the prices the companies expected. Step 4. Survivor bias. The companies that make it through the gate when it reopens are not the same companies that were ready when it was closed. They have been through the drought. Some emerged stronger. Most emerged thinner. A few did not emerge at all, and their data points vanish from the analysis entirely. This chain is not one-directional. It oscillates. The gate opens. First-round valuations get pulled to the ceiling. Public market investors get burned. Sentiment drops. The gate tightens. Backlog builds. Pressure forces the gate open again. The cycle repeats. The 18A data shows this clearly. 2018 to 2021, gate open, heavy listing, pricing stretched. 2022 to 2024, gate frozen, backlog accumulates. 2025 to 2026, gate reopens, first day returns hit 233%, but 70% of the old cohort is still underwater. The new wave reprices upward. The old wave has not recovered. What drives this oscillation? Regulatory intent doesn't drive it. The structural gap between private market valuations and what public markets are willing to pay does. When the gate opens, private markets rush to capture the spread. The spread gets consumed before public investors see returns. They get burned. They pull back. The gate tightens again. So what's different this time? 3 things. First, execution has become a verifiable asset. The CDE's 2025 annual report shows 5,215 drug clinical trials registered, up 6.4%. First-in-class drugs account for 72% of new drug trials. Average time to start a trial, 6.8 months, 4 months shorter than 2024. 96% of approved trials started within the same year. MRCT's multi-regional clinical trials hit 410, nearly double from 2020. That data is not just a health check. It is the hard evidence behind the BD wave. In Q1 2026, China-related biotech deal value reached $61.4 billion USD, roughly 70% of global pharma transaction volume. Already surpassing full year 2024, MNCs are not buying Chinese drugs out of charity. They are buying execution speed. Second, the growth layer is functioning as a filter, not just a door. 34 companies in the layer, revenue growing, losses shrinking. 15 have already done secondary offerings, raising 21.9 billion RMB. 6 have crossed profitability. The structure is absorbing companies, testing them, and graduating the ones that execute. Opening the gate alone is not enough. You need a mechanism that separates signal from noise. Third, the dual platform option is real. 19 A plus H listings in 5 months. Companies that once had to choose between A-share valuation and Hong Kong accessibility can now access both. That reduces the liquidity discount problem, at least for companies that qualify for both markets. But here is what has not changed. The oscillation risk. When the fifth standard expands to AI, quantum, and embodied intelligence, the pipeline will fill quickly. Valuation expectations will run ahead. The same structural gap between private and public pricing will reappear. The gate opens wider, but the force pushing companies through it is the same: pent-up capital seeking exit. That pressure does not respect the quality filter. The exit pathway reopens. Two signals confirmed it this month. The question I ask is not whether the gate is open, it is whether the companies lining up built something that survives the passage. Cambricon survived because execution closed the valuation gap. The 6018A companies that broke below IPO price did not fail because the gate was wrong. They failed because the timing was wrong, and the execution was not fast enough to compensate.
Position decides return, even at the exit. The gate controls access. Execution determines outcome. If you want to discuss China's exit pathway and capital market logic, leave your comment or connect with me on LinkedIn. Next episode, Deep 6 position in the AI value chain and why capital structure reveals what revenue does not.